Was that Jen?
What music is this, Fakale?
Peak.
Oh, it's the Peak
Hey,
Partnership.
guys.
Nick, how'd
Oh,
you,
Peak State from Tony Robbins.
oh, cool.
Yeah. Yeah. Hi, Jen.
Hi guys, thanks for joining us.
Jen.
Hi everyone.
Hi.
Ooh.
So good to
Thank
see
you.
you guys.
Dave. Thanks for hopping on.
Yes.
Jackson.
Jackson, is this the Jackson that I know?
Jackson, if it is, pop on in. Say hello.
Hey Daniel, it is the Jackson that you know.
Awesome, man. Oh, awesome. Nice to see you, bro.
Awesome. Ashley.
Kaini, hi. Thanks for being here. Alicia,
Lainey, Ali,
Ashley.
Sasha.
Hi.
Hi. Oh, so awesome. Everybody's rolling in. If you guys could all please share your names and where you guys are located in the chat, that would be heavenly. We're gonna begin at 5:02, 5:05-ish. But yeah, you guys can connect in the chat. We want to know where everybody's from.
Feel free to network in the chat too.
What's up, Kaini?
Kaini.
Kaini.
Hi.
Wine in the house. Represent.
Nice.
West side? Nah, just kidding.
Yeah.
That's awesome.
Are you guys gonna go to any other visit anything other conferences in the near future?
Yeah, you go first, Walkway.
Maybe not right now.
Mm.
Maybe not right now. At least for me. Not for maybe till like the end of the year, if anything. Yeah, I feel like we have so much moving. That's why.
Yeah.
Yeah. We want to keep the momentum going.
There's one in September, I think, to meet some of the other.
Oh,
Yeah.
That's a good
That one's
time.
supposed to be a good one.
That's
I want to
what-
go to that one. Yeah.
What is it? The best ever?
No, it's something else. I can't remember what it was. Something partners.
It's like another MFM, not MFM, but another multifamily, right? I forget.
Yeah.
So, goodness, somebody was telling me about it too. I think it was like Jerry and Anthony. I was telling me about it, but they said it's like really good. It's in September. I don't know if I'm gonna go to it yet, but right now
we're the one we have, like, we're under contract in Houston with Shanron. I might go visit the units, and it's like go visit
cool.
in,
That's
in
awesome.
a couple weeks or so. So we'll see.
Yeah, that's awesome. Alicia from Kapolei. Sasha.
Yo,
Eva.
Eva.
We're gonna be there very
It's on
soon.
West Side.
In like 2 hours, 3 hours.
What do you guys do
People
over
are-
there?
We're gonna go get dinner at Cheesecake Factory.
Nice.
Yeah. We all need to get together after though. For
Yeah.
sure. Everybody.
Oh, Daniel, you mentioned this one in Houston. So is this one a different one?
Whatever. I mean, Chatteron is like 102 unit. I'm not sure if you guys saw that, but
People are rolling in. Aloha, everybody. Thanks for coming on. If you guys can please share your names and where you're located in the chat, that would be awesome. We want to get to know everybody.
Thank you for being here.
Yeah.
yeah, we gotta hang out sometime, Jackson, bro. Like it's crack-a-lacking, man.
Ampa in the house.
Michael, Russell, Mana, Kim, Andres. Oh, nice to see you.
He's actually in the other room working, I think.
Oh, nice. Janelle.
Love it.
Okay, I don't know how to say this, but AJVAN. How do you say that? Avon?
I was just thinking I didn't want to butcher your name either.
Yeah.
So I said Tampa in the house. We see you, man.
Okay.
It's Ashvon.
Okay.
Ajamon. Thank you.
Thanks.
Thanks for being here. I think you're the only one not from Hawaii right so far.
Nice. And if you do any real estate investing already, let us know as well. Do you do any
Right.
single family? Are you passively investing already? Let us know. Kiane. Keane. From Big Island. Hell yeah.
Love it.
Dalton from Honolulu.
Is this Dalton that we know? Dalton?
It is poppin'.
Oh, I love it.
He is from Oh, nice. Ah,
Welcome to multifamily.
Airbnb and VRBO is 2
Oh,
years. Cool.
oh, that's awesome. My dad's side of the family is from Waimea. So love it.
Kailua, nice. Miranda, I've lived in Kailua my entire life. We just moved to Kaneohe.
It's 5:02. Hi, Ken.
Okay, we're gonna start in a few minutes. 5:05, yeah, Kihal?
Well, actually, we're
Start
supposed to kind of start now.
Okay.
Yeah, and then as people start filtering through, just to be mindful of everybody's time.
Roger that. Okay, we're gonna get started. Thank you guys for being here. We are happy that everybody's here and they made it. We want to be mindful of everybody's time, like Yahal said, and we're gonna get started. So my name's Wakale Sasaoka, and I'm a part of the team AL Capital Partners. And Kihal, you want to get into it?
Chris. So I just want Chris to introduce himself real quick. Chris, you want to introduce yourself?
Hey guys, I'm Chris. Welcome. Moderating the
So
yeah.
he's the wizard. And then I'm Kihal. So just to kind of give you guys just a little bit backstory on us, we as a team have been in the real estate space for about 5 years. We collectively did about a little over 6 million in real estate transactions within that time. And our mission is to get 1,000 families on their journey to financial freedom. And, you know, our team, we have invested a little over 80,000 into the multifamily space. But that in turn it allows us to pour back into all of you. And we want to be able to provide resources back to our community that helps you guys get educated in the real estate investing space. And however that looks, how it can help you guys. So we want to know like what your guys' whys are, what you guys are looking to kind of achieve. If you guys could share that in the chat, that would be so awesome, because then we would know how we can help you guys. And that's one of our biggest things. So yeah, that pretty much wraps up our backstory on who we are, what we're looking to accomplish. And I'll let Chris go ahead and introduce our awesome key speaker today.
Awesome. So I'm gonna try to moderate and speak at the same time, but thank you so much for coming. We have 31 people in the room right now, going to be more in a few minutes. But ladies and gentlemen, brace yourselves for this awesome individual. His name is Daniel Kong. So we got to know him a little bit through the past few months, and we invited him because we were blown away about his growth as an entrepreneur and investor. And he's a successful local boy from Pearl City. So Pearl City represent. So let me tell you about Daniel. So he has over 10 million real estate as his portfolio. In 2022, he and his team has given over $700,000 in profit. And 2023, he has even bigger goals, and he'll tell that himself. So when he's not talking about real estate and educating people, he's always posting about his travels and his foodie adventures, always jealous about the things that he eats. And let's not forget his sexy Lamborghini. Pretty awesome. You can follow him at Daniel Kong 808. And let's give a round of applause for the one and only Daniel Kong.
Yes, thank you, Daniel.
Thanks, thanks, Chris. Yeah, and so I'm just like super just happy to just kind of share a little bit today, just a little bit about my journey, but also kind of like talk about what we're doing in the multifamily space. And so the short story about myself, I was a software developer for like a long time. And then after reading this magical book called Rich Dad Poor Dad, I found this whole world of entrepreneurship, passive income, and just real estate investing. And over the next 3 years after reading the book, I just went really hard into like the BRRRR strategy and single family houses. We built up a rental portfolio using the BRRRR strategy to build up our passive income on rental properties to replace what I was making at my job as a software developer. So after like eventually replacing my job as a software developer and negotiating with my wife to allow me to quit my job, I was able to just pursue real estate investing full time. So the last like 3 years, I think we've been like fix and flipping in Hawaii, and just recently we've been buying some commercial buildings on the mainland, and then just kind of starting getting into the multifamily space. And I'll kind of give you like a segue of like how that happened. And so one of the things we do on the single family space is we fix and flip houses here in Hawaii. And because the price points are kind of high, like let's say you're buying a house for like 800 and you're selling it for maybe 1.3 million, we raise a lot of capital from hard money lenders and also private money lenders. And like we think we really enjoy like that aspect of it, because in return for like their time and or in return for their money, we give them like a very good return back. And the return back on typical private money lender is like a 12% fixed rate. So let's say like someone lends us like $100,000 every month, we'll give them like $100,000 in returns to until the project is finished. And then when the project is finished, they'll get back that $100,000. And so we've done this pretty successfully for the past like 2 or 3 years, and our investors are very happy with their returns. Actually, like Chris mentioned before, that last year we were able to give about $700,000, actually over $700,000 in interest, and also some partnerships that we made for like our single family homes here in Hawaii. But one of the things is like, because like deals are very hard to find in Hawaii, what we're finding is that there is a lot of people who want to invest with us, but there's not enough deal flow or enough like opportunity we're capped at how much we can offer. And so I think we have like maybe like 12 fix and flips going at the given time right now. I think we have maybe like 5 million in private money lenders just who are funding some of these deals. But then there's also more people who want to lend with us, but there's not enough opportunity because we are very like kind of picky on the deals we're selecting, and there's just not enough opportunity. And then in addition to that, a lot of guys will hit us up on Instagram saying like, hey, I don't want to lend money, I want to partner with you on some of these deals. And so the big thing is like, how can we find like we're looking for like a way to like do bigger deals and have an opportunity where people can partner alongside us, as well as like make good returns, and that's backed by real estate. And then hence welcome the world of multifamily investing. So kind of give you the contrast between single family and multifamily investing is I'll kind of go over the difference between being a private money lender and an LP on a multifamily syndication deal. So when you're looking at the multifamily space, you can do it either passively or actively. And the same with the single family space. If you're looking at the fix and flip space, you can do it either passively or actively. So what we are doing right now is actively fix and flipping houses. And there's a lot of other people who are very successful that are doing that in Hawaii. You can make a great return, and it's a great way to build up cash very fast. But then if you don't have the time or energy or kind of resources to learn and put in the effort, then you can invest passively in single family fix and flipping. And that's when you become a private money lender. And the exact same is true for the multifamily space, where you can do it actively. If you do it actively, there's a lot bigger returns. There's a lot bigger, like you can scale and grow faster, but then you also have to put in the time, energy, and effort that's going to be required to do the multifamily. And the thing about multifamily that I really like is it's a team sport. So in a typical multifamily deal, there's 4 seats that you're trying to fill. One of them is like the deal finder, or someone who's going to negotiate and lock up the deal. They're going to underwrite, like put out offers, talk to brokers, build relationships, and find the deal. So that's the first seat. The second seat is the person who's going to raise the money to be able to purchase the deal. So that's they call them like the capital raiser, where the person who's going to either gather their friends or kind of recruit people or market the property or market the deal. So people want to come in and invest alongside and to purchase and like renovate the property. The third seat is the asset management seat, where these are the people or the group of people who are going to actually be the manage the asset, turn it from $1 million into a $2 million, or from $10 million into a $20 million building. And there's like a lot that goes on to that, whether it's renovating houses, working with property managers, or doing those kinds of things. And then the fourth seat is called the sponsor or the key principal. And this person is the person who's going to be either bringing their net worth, they're going to sign a personal guarantee on the loan, or they have the multifamily experience to kind of oversee and make sure that the deal does well. And so this is probably the most important person, because if you have a good sponsor, they're going to make sure that the deal that you chose is right. They're going to make sure that the deal is running correctly. They're going to make sure that you're dotting your I's and crossing your T's, and making sure that the general partners and the limited partners and everybody involved is going to make money. So that's kind of the active side, kind of highlighting what the active side looks like. But we'll kind of like talk about more on the passive side for the next like couple of minutes. And so the way the passive side works is that in the single family space, on the passive side, somebody will lend money for a short period of time, typically between 6 to 12 months. And then during that time, they're going to get like a steady rate of return, typically between 10 to 12%. And the good part of that is like the 10 to 12% is fixed no matter if the deal does good or bad. So let's say the fix and flipper like makes $1 million in the deal, you're going to get your 12%. Let's say the fix and flipper loses $100,000 in the deal, you're still going to get your 12% return. So that 12% return is not tied to the success or failure of the project. In addition to that, you're guaranteed it every month as cash flow. So like if you're to lend, let's say, so we actually had like somebody who their friends had a HELOC on their house, and they had like $500,000 locked up in the HELOC. So they borrowed the HELOC at like a 1 or 2% or something crazy, lent it on one of our projects, and then every month we gave them $5,000 in like a passive income to supplement, so they can either go travel or buy groceries. We actually had one of our lenders who told us like, hey, we bought a new Lexus, or not Lexus, a new Tesla from the year's worth of like $50,000 that we made off our passive income. And so, and just like a very steady return that you're going to get as a lender on a fix and flip project. And a lot of our lenders like this because it's very short term, typically between 6 to 12 months max. So if it goes past 12 months, you're going to get your principal back, and you get the option of either investing in another deal or reinvesting in a deal if it's taking longer. So that's one thing that our investors really like. And the second thing is the guaranteed cash flow. So as opposed to like the LP parts or on the syndication side, the cash flow is guaranteed every month, where whether the project is doing good or bad, you're guaranteed that $5,000 a month check to support you, right? Whether you're using to pay rent, pay for college, your child's like college tuition, or like private school or whatever it is. So like that's what our investors really like, the lending on the single family space. To contrast that, on the multifamily space, it's usually a longer term, so between 3 to 7 years, kind of averaging around 5 years. The returns are projected based on like how good or bad the deal does. And so like if the deal does usually according to plan, you'll get about a 20% return annualized over like that 5-year period, which is bigger than the 12%. And so that's a good thing about the multifamily space. But in addition to that comes a little bit more risk, because if the deal does bad, instead of making 20%, maybe you only make 8% or 7%. But on the upside, if the deal does well, then you'll make like, say, like 30 or 50%. And if you look at the operators who have been operating the last like 5 to 10 years, because the market has been on such a bull run or such an upward swing, all the syndicators who've been syndicated recently have been able to give returns of like 25, 30, 50% returns, because the market has been so hot. And so if the operators that you're working with have not been giving you like outsized returns, that might say something about like the operator themselves, just because the market has been so hot and nobody can lose in the past like say 5 to 7 years. So the other thing that's good about the syndication is that there are tax benefits. So typically we do things called cost segregation and a bonus depreciation, where when you invest money, you can take a paper loss on the first year. It's a passive income paper loss. There's a way to apply it to your active income if you do certain things. We won't go into the nitty-gritty details of that. If you want to talk about it in the Q&A, we can break that down. But basically, the difference between like the single family and the multifamily spaces, the multifamily spaces, you're actually a part owner of the property. So like during the time that you're investing, you're going to get the benefits of the cash flow and the tax benefits that come alongside of that. So that's kind of contrasting between like the pros and cons of the single family versus multifamily space. And so to kind of like really like just wrap it up, if you're contrasting the single family space, you're going to get consistent cash flow that's guaranteed at a 12% rate. You're going to get like a shorter time frame, so you'll see your money back again shorter, and then you can reinvest or make another decision on it. But the downside is you're not going to get any tax benefits, and you're capped at that 12% return. The upside of the multifamily or syndication LP side is that you potentially can make a lot more than the 12%. Projected 20% on average is an average return, but then potentially 30 to 40, 50 if the market is doing well or your operators really know what they're doing. And then on top of that, you also get the tax benefit. So you're going to get like in year one, a typical return, like let's say you invest $100,000, you might get a $50,000 or $70,000 paper loss in year one. So that can help you, whether it's like you have other passive investments, other real estate investments, you can roll it forward to when you're actually going to get your profit on year 5, or you can just apply it to your active income if you're qualified for this thing called rep status. And so those are kind of like the big key differences between like lending on a single family space and on the multifamily space. And I think like both of them are good ways to like to build wealth. And I think personally, I think real estate is like the best way to build generational wealth, whether you're doing it actively or passively. But so the other thing we kind of want to highlight more like the passive side, because most of the people who are coming to us who are saying they want to invest, say like, hey, Daniel, or hey, Wakali, I don't have time to invest. I just want to invest in real estate. I want you guys to do all the work and like make sure that you're taking like all like the making sure you're dotting your I's, and like we trust you as an operator. So then we don't have to learn all the things about the taxes. We don't have to learn all the things about handling tenants. We don't have to learn all the things about the laws, the permits of like the landlord laws of that particular area. We're trusting you and your team to do all this work, and then we just want to be able to invest passively and let our money grow. And so I think it really depends on like your perspective or like where you are in your investing journey. So like if you want to like, I want to be more active, I want to do like make my money grow faster, you definitely can do that if you're more active, both on the single family and on the multifamily space. But if you're like, hey, like I have kids, I have a good job, I just want to spend time with my kids, I want my money to grow like without me having to do work, I want to have the benefits of owning real estate, but not having to put in the work or the hassle of it. I think being a partner or limited partner on a syndication or on a single family fix and flip are both like great alternatives. And so that's like basically the gist of kind of what we want to cover, just like the big things, an overview of the single family active, multifamily active, and then single family passive, and then multifamily passive. And so maybe I'm not sure if people are falling asleep or not, but that's basically like the gist of what we want to cover, and maybe we can open up for questions.
Awesome. Thank you so much, Daniel. Yeah. Miranda just said so much wisdom and info in such a condensed time.
Sorry, I mean, I know I speak very fast too, and like it's a little hard with
No.
only seeing my face on there without like interaction. I usually like to have some interaction to see questions and see what people are like, who's falling asleep, what they like to see. And so that's kind of like a really quick rundown of like a single family versus multifamily, active and passive. And I think you have to find what you're passionate about and what you have like time and energy to learn, and then kind of focus in on that particular aspect of real estate. So
yeah, exactly. So thank you for sharing both sides, the active and the passive, the single family, the multifamily. Thank you for your time and all of your knowledge that you just bestowed on everyone. I'm sure you guys all have a ton of questions. Please, if you guys can unmute your mics and open up your videos for a second, just so we can see all of your beautiful faces. And if you guys have any questions, please share them here. We'd love to hear your voices. And yeah, let's get into it.
Yeah, don't be shy, guys. Ask some questions. This is the fun part.
Yeah.
So if you have something,
my dad's here.
So let's get those questions going.
Daniel, so Kaini said, not falling asleep, just trying to keep up with you. So you dropped a bomb of knowledge, and I think that's what everybody is trying to do, is just like take in everything that you mentioned.
Yeah. And just to point out, I think one of the biggest differences between multifamily and single family, if you heard in the last part, the multifamily side, you get a ton of tax benefits. So if you are somebody that's looking for a tax break of some sort, multifamily is the way. If you're looking to be more passive, either opportunity is great. but you just have to see what is in alignment with your goals, what financial freedom looks to you, and then pick a vehicle that works best. So, sorry.
One of the common, like, I guess, strategies that people would use, like, you'll see like doctors where in order to take the loss in the multifamily space against your active income, either you or your spouse has to qualify for these things called rep status or real estate professional status. So a lot of guys, like, let's say like a doctor, he makes like $500,000 a year. He'll get his wife to like get rep status. Maybe the wife makes $500,000 a year. She'll get her husband to get rep status, maybe become a realtor. So now when they file their taxes jointly, they can take that loss that they're taking on the multifamily syndication and apply it to her W-2 income. So like, let's say like quick like example is, let's say like the wife makes $500,000 as a doctor. She'll invest, let's say like $300,000 into multifamily syndication. Because the husband has a rep status, then like in year one, they can take, let's say like a $200,000 loss, a paper loss. They can apply that directly to the husband or the wife's W-2. And now she only made $300,000 in the eyes of the IRS, even though she made like the full amount. So it's a great way to kind of shelter some of your taxes and your W-2 if you have a spouse that's willing to do or qualify for the rep status.
Awesome. Thanks, Daniel.
Or if you're a realtor, then like automatic qualify. So if you're a balling realtor, you're making $500,000, then like get into a multifamily syndication, you offset your active income like right off the bat. So.
That's good to know.
So we did have a question that came in through one of our posts on social media, where we had two questions. One question was, can you explain a little bit about cost segregation, how that works? Is it only in the first year? That's one question. And then I'll go into the second question after.
Sure. So like a cost segregation is basically like in a typical, like let's say you own a property that's worth like $1 million. And in Hawaii, typically like a $1 million property, you've got like $800,000 worth of land and $200,000 worth of building. But in the mainland, like these Kansas City or Texas or Florida markets, when you purchase a house or a building for $1 million, the land is almost worthless. So you got maybe like $900,000 worth of a building that you have, like, so it's a lot bigger building, more tenants and everything, but also a bigger tax deduction that the IRS gives you. And so typically when you have like, let's say like $1 million building and you have $900,000 worth of land in a multifamily building, you can do this thing called depreciation, or it takes a IRS tax credit, divide that by 27.5. So commercial is 39, but then multifamily and single family is 27.5 years. So if you, let's do the math on a $900,000 building, you would, every year you can take, let's see, 900 divided by 20, so 900 divided by 27.5. Every year you can take a $32,000 tax credit or against your passive income or rental income. But what you do in a cost segregation is you take that $900,000 building. It's like, hey, like the windows are gonna go like faster before like the roof, or the roof is gonna go before the siding or the walls, or the carpet inside is gonna go faster than, let's say, like the foundation. And so you kind of part out that 900,000 into different buckets, and there will be some that will take 5 years to depreciate, some that will take 10 years, some that will take 20 years. And because of that, you can kind of say like, I'm gonna depreciate like more early for these different buckets. In addition to that, there's some like some things called the bonus depreciation, where you can take, as opposed to depreciation over 5 years, you can take the whole thing in year one. So basically, you're spreading out your $900,000 deduction, as opposed to taking over the next 27.5 years. You're basically almost taking the whole thing in the next 5 years. So in year one, you can take, let's say, like a $300,000 just from like the bonus depreciation, and kind of splitting up the house into different buckets, but then kind of taking it all in the first year. And this is really powerful because as opposed to waiting for it to like slowly get like over the next 27.5 years, as an investor, you can take that $300,000 in year one, offset your active income or your passive income, and then like just worry about like the next deal after when you buy next year to take the next like big depreciation. So that's kind of like the cost segregation in a nutshell.
Awesome. Thank you so much, Daniel. And we did get a question in the chat. So I'll just go ahead and read this. This is from Michael. It says, are there investment opportunities for people who can only invest $10,000 instead of $100,000?
So yes and no. So like it depends on that particular deal. So it's a deal by deal basis. there are deals that like, so a lot of deals will have either a 506C or a 506B designation. And the difference between that is for a 506C, you have to have like a net worth of $1 million, not including your house, or make like a $200,000 a year. But then, so then that's like a 506C fund. The 506B fund typically is you don't need to have the net worth, but you have to know the operator or have some prior relationship with the operator like before you invest with them. And so usually in the 506B funds, they'll have opportunities for you to invest a lot less, $10,000, $50,000, or like a lot less than the bigger amounts. But typically in the 506C funds, there will be bigger amounts, but in the 506B funds, there's a lot of times there's opportunities for like the investors to take 2,000, 10,000, like 15,000, whatever it is that you're able to afford.
Awesome. Thank you so much. And guys, keep those questions going in the chat or raise your hand if you guys have any questions. But the second question coming from social media was, I see ARR a lot. I'm new to the multifamily space. I'm looking to be a passive investor. Can you explain to me what the difference is between ARR and pref rate?
Sure. So you should go watch my videos on Instagram, Daniel Kong 88 for more deep dive. But basically, an ARR is just the average rate of return split up over a period of time. So a quick example is, let's say you invest $100,000. Let's say over like the entire course of the year, every year you make $20,000, and then you get your money back at the end of the year. So your average rate of return or accounting rate of return is 20% because you made $20,000 off that $100,000 every single year. Let's say another example is that you invest $100,000. For the first 4 years, you make $0. But in year 5, you make $100,000. So you made $100,000 over those 5 years. You take that 100,000 divided by 5, and it comes out to the same 20%. So that the ARR in both those cases is both 20%. So the ARR is just like the amount of return you're going to make over a period of time divided by the number of years it took to make it. Whether you make it all up front, make it little by little, or make it all at the end, the ARR is just an average of the total return you made over a period of time. In contrast to that, the pref return is basically when we're paying out as on the deal, there's profits that are made like every single year, and then also at the end of the year. But if there's certain people who are getting the profit first. So a quick example of it, let's say like the deal is like $1 million, and let's say there's investors who invested $500,000 in that deal, and then they're going to get the pref return of, let's say, 8%. So I know there's a lot of numbers are kind of going on over here, but let's say that deal itself is in the first year, it only made like let's say like $50,000 or a 5% return. The guys who have a pref return, or let's say like the 8% return, they're going to get any profits sent to them first before anybody else touches any profit. So that 5% or $50,000 is going to be split between like the investors who have the 8% pref return before anybody gets any profit. And so they're going to get that first 50,000 and nobody else is going to get any money. The second year, let's say the project makes like 6%. Okay, now that $60,000 is going to be the same thing. It's going to be spread out between the pref return partners or limited partners first before anybody gets any money. And then, so nobody's going to get money except for the people who have the pref return. Let's say in year 3, there's a 10% return or 100,000% return in year 3. So because there's an excess of the pref return guys get the first 8%, but there's 2% that's left after. So sometimes this is usually split like a 30-70, 30 for like the general partners, 70% for like the limited partners, but that part can be split a lot of different ways. But the general idea is the remaining part is split between everybody else. And so all a pref return is just saying you're guaranteed the first part of the profits that's made before anybody else kind of touches the pie. And then at the very end, let's say like there's a big payout to make sure like the guys who have the 8% return get like the full 8% annualized over those 5 years before anybody else is paid out. So because they only made 5% and then 6% the first year, now you have to retroactively pay them for like the 3% and 2% difference, get them to the 8% first. Now the leftover profit is split between all the other guys. And so that's what a pref return is and versus like an ARR. They're really like very different things.
Thanks, Daniel.
Awesome.
Dude, you're like a wealth of just real estate knowledge.
For real.
Yeah. That is great. We
And
have
then-
another question.
Yeah,
Okay.
one more question in the chat. Sorry, Walkley, go ahead.
No. I was just gonna read the question. What markets are you guys targeting for multifamily?
I think for us, I think we're targeting like cash flow and tax, like, I mean, like, so everybody's like different, but I think for our team, we're targeting landlord friendly, cash flow heavy, and tax friendly like states. And so basically things where on average it's easier to get cash flow and it's easier to like work with like as a landlord to be able to work with your tenants. It just makes the whole process less risky and like more profitable like throughout the whole process. So I think we're personally looking for like in Florida, Texas, and Kansas City. That's I'm not sure where you guys are looking for at.
That's the exact same.
That's it. Yeah.
Right.
Yep.
Love those states.
No, exactly.
So I guess that's something that we can touch on. We didn't have a question, but can you talk about how you defined your markets, like how you pick your markets? I know you kind of mentioned cash flow, but talking a little bit like about emerging markets, job growth, things like that.
I think so. Like basically you want to find markets that are the perfect market is one that's on the upswing. And so you never want to have a market that has like declining population or a market that's like only has like one kind of like economic center. Like you always want to have something where there's like a wide range of economic factors and there's an increase in population and a foreseeable trend of population increase for the foreseeable future. And so the reason why this is important is because as a multifamily investor, our real client, our real thing is just people, right? So the more people that's moving to an area, the more jobs that's created, the more things, the more kind of people you have to fill like your buildings. And just it's a general, like in general, the more supply and demand, the more supply that's demand for your buildings, the more that you can increase rent, the more that things change. And if you even look at Hawaii, like the more people that move into Hawaii, the more that the prices go up in housing for like rent and for like the housing prices. And so number one is you want a market that's emerging. So like if you look at like, let's say California, people are moving from California to Texas and to Florida. Texas and Florida becomes very attractive because we see these markets as far as like they're exploding in population. People are moving there. There's more jobs. There's creating more opportunity for like the rents to naturally rise. And so when you're underwriting your deals, you're not writing in the natural appreciation of things or the rents, but then like you're gonna get it like anyway. And so like this, it just makes your deal more safe or more secure when you know that the population is increasing. And just, in addition to that, there's other things like a minimum population because you want a metro, you don't want like the outskirts of town where it's like a little bit more hard to find contractors or a tenant pool. You want like at least $100,000 like population size or more, the bigger the better. And then there's a few like other things like being a landlord friendly state. There's things like taxes and some other things. So but generally we want states that are on the upswing and then they're easy to work with as far as like the landlord and tenant laws. So.
Thank you. And it all kind of ties back right into why multifamily could be so secure, right? Because it has all of these backings and all these different criteria that you want. So you kind of, you're placing a safer bet, basically. You're mitigating your risk by being able to do this. Would you agree?
Here's a big thing is like, because most of the things we're targeting is at least 85% occupied or higher, then like it's cash flowing from day one. So when you're picking up the asset, like on a fix and flip, like when you buy the house, like you're negative cash flow because you're just bleeding until you sell it, right? There's no kind of recourse. So like if you have, the longer you hold it, the more you bleed out. But in the multifamily deals that we're buying them like 85% occupied. So from day one, it's already positive cash flow. So worst case scenario, we hold it for like 10 years, we're positive cash flow and there's no chance to ever lose a property or to bleed out because it's positive cash flow. The downside is if you hold it too long is your returns are going to typically be less because the longer you hold it before you sell it, the ARR is going to go down. But then as far as like the safety of the property, like because it's cash flowing from day one, it's like the safety of the asset is very secure in the multifamily space.
Right. Just like with any investment, right? There's always going to be a risk. So mitigating your risk is the best way to go. Let's see. Do we have any more questions in the chat?
Sorry for the quick numbers, man. Like I know like sometimes it's hard like to keep up the.
No, it's so good. It's so good. And guys, there's going to be a recording of this too as well that we're going to send out. But Chris, go for your question.
I definitely think people who are new to this space and they don't have the cash reserves, like I know there's some accreditation that it's required to invest. What's the quickest way for someone who is new, just building their wealth to achieve this, whether it be through HELOCs, 401k, IRA?
Mhm.
If you could answer that, please.
Yeah, I mean, so like there's two ways to invest, right? You can invest either actively or passively. And so if you have no money and like you don't have access to any money, I think maybe the active side might be a better avenue to kind of get started to kind of build your wealth. But realize that it's a lot of work, there's a lot of learning, there's a lot of networking and resources that's going to be involved in that space. And so just be prepared for like, you're not going to make $100,000 in your first month or 2 months, right? You're going to have to put in it's going to be a grind. But if you do have some like access to funds, whether it's equity in your house or 401k or different kind of things, there's always ways to kind of unlock that equity. And so maybe like, as opposed to like keeping your 401k in the stock market, you can do a self-directed 401k and invest it in a syndication or a fix and flip project. Or same with like if you have a HELOC or like equity in your house, you can take out a HELOC and take that money that's doing nothing and invest it in something. So this is a great example is like we have friends who have parents who have just like money. First of all, there's a lot of people who have money just sitting in their checking account doing nothing, which is like kind of bad. So like I'd say like get it out of your checking, invest it in something, whether it's stocks, whether it's bonds, whether it's like a fix and flip project or like a syndication, just get it out there and start to get it moving. But there's a friend who had parents who had like equity in their house. They took out a HELOC for $500,000. The equity is sitting there doing nothing. They took it out, borrowed it at 2%. We paid them out at 12% rate. And so like every month we wrote them a check for $5,000. It was a direct deposit. But then they basically had like out of thin air, just their house, they created like a passive income or cash flow that they could count on and rely on for like for groceries or for buying the kids or their grandkids or whatever it is. The same thing can be done for the multifamily space. Just realize that it's a little bit of a longer hold. So you're kind of playing a little bit of a longer game. The return should be a little bit better, but then you just have to be prepared for like that 5-year hold to kind of see your exit. So it really matters on what's important to you. Do you want to make a little bit more money, but you're willing to put it in longer and get some tax benefits? Or do you want the monthly cash flow, but it's be a little bit less with no tax benefits? And so those are kind of contrasting the kind of different like avenues you can take. But the big thing is just unlock any kind of access to like either equity, even personal lines of credit, or whatever it is that you can to kind of just start getting invested like sooner than later.
Awesome. Thank you so much. A lot of people had that question.
Daniel.
Yeah.
Yes.
So thanks. Yeah, but like Daniel just said, you got to figure out what it is that you want, right? Do you want that long term? Do you want that shorter term? Do you want the cash flow? Are you willing to do the equity game, right? With the tax game? You really have to figure that out. And we, all 4 of us here today, we can sit down and talk story with you guys to better understand and map out a plan specifically for each one of you guys and specifically for each one of your families as well. So if you guys have any more questions, let us know. We will continue this, but we have a couple more minutes. But we just want you guys to know that not everyone is created equal. We all know we're all on our own crazy journeys. So we want to help you guys, and we want to help every one of you guys get to where you want to be and be financially free as much as we can. So, yeah.
I think one of the big things is people are just not even aware of these opportunities exist. And typically, I think in school you learn about the stock market or like savings and bonds, which are excellent like alternatives, but they're different. They have their own like risks and reward and upsides and downsides. And I think just like being educated, just like so you can see and contrast the different kinds of opportunities that you have as an investor or as a homeowner, or whatever it is, and see what's the best fit for you. And so I think like we're not saying like the multifamily is the best, although I think it is. We're biased, but then like there's other opportunities like stocks and like crypto, these other kinds of things. But I think the big thing is just being educated and being aware of what your options and then what fits you for your season of life like right now. And so that's I think all we're trying to do is just say like here's some options that a lot of the general public is not even aware exists. And here's like some opportunities where if this is something that's interesting to you, let's have another conversation and just see if this is a good fit or not. So
yeah,
Second.
exactly.
I did have one last question from Instagram, but just to touch what Huakley said, like, yes, everybody's situation is different. Everybody has, different things moving in their life and what they want to achieve. So definitely sitting down and just getting like a strategic plan on what can help make things clear for you. Definitely can reach out to any 4 of us. But this question is specifically for Daniel. because you started in the single family space and you're doing it, this is a question about scalability. Would you say that multifamily, you're able to scale a lot faster coming from a single family flipper? So that's a single family flipper asked this question.
It's that's like a tough question. Like that can be answered, I guess, a lot of different ways. I'd say yes and no. And like it's such a different game. And like I think you can scale in both sides. I think the single family space is a lot easier to get into. The multifamily space is more of a team game. So then you're playing more of a team game, but it's also like the upside of multifamily is a lot bigger. So like into scaling in single family spaces, typically you're going to do more deals, and then you're going to have to do either bigger price points. You're going to have to build a team, like, and then like kind of manage a team. And the multifamily space, you're going to have to either join a team or like find like a niche or like grow. I mean, so both of them are scalable, but the multifamily space has a bigger upside because you can do bigger deals, I think. And so like for the same return of your time, as opposed to doing like $1 million deal in Hawaii, I can do a $10 million deal in Kansas City. Of course, the split is like you're usually not going to get the full $10 million profit, but then like it's easier to like take a small piece of the 10 million and to do another $10 million deal in the multifamily space. And so that's kind of like I mean, I'm not sure if that's a good answer or not.
No, I think that was great. I think that's kind of like what they were looking for, is that they were trying to see if it's worth for them to put more of their time. Like you said, you're working with bigger scaled projects, and you're putting in similar time and energy into a smaller project that you could be doing on a bigger project. Of course,
here's some advice though, is like whatever you choose, focus on that. So like if you're gonna do like multifamily, focus on multifamily. If you're gonna do single family, focus on single family. And the thing is, like, if you just make a lot of money, then you can invest passively however you want. So like if you're just really good at making money in single family space, just make a lot of money and then invest passively after that. But then just take your focus, make sure your focus is on the income generating activities as opposed to kind of being like too diluted. So if you're trying to be active in multi and single family, it's very hard. The only reason why we're able to do it is because we have like a big team, and we kind of have like somebody who's overseeing our single family space now. So now I can just focus on the active multifamily space. But if you're very good at the multifamily and it's working, I'd say double down on that. I mean, on the single family and it's working, double down on that, become very good, become better at that, make more money, and then just throw it into a multifamily. Or if multifamily is something that you're interested in, just double down on the multifamily and forget about single family and just focus on one thing.
Awesome. Thanks, Daniel.
Advice.
And I know like we're about to wrap up pretty soon here, but can you tell us just a snippet or a little bit about the deal that you're working on now? Just a snippet about your multifamily deal.
Yeah, so I mean, one of the things I think that you'll see that the way that we bring value is that we're partnering and we're vetting deals like on the daily. So we get like 10 deals sent to our inbox every day from a lot of people who want to work with us or work in different things. The one downside about Hawaii is that it's not a great multifamily market because of like the cash flow and the depreciation. So typically as investors, we're trying to partner with people on the mainland who have the boots on the ground and who have like the teams who are working over there. And so our value that we're bringing to you is like, hey, we're gonna do all the research. We're gonna do like vet the operators, vet the people and the deals on the mainland. And then we're gonna also have like an oversight part of that to make sure that we're the liaison between us and the people over there. So like when we hui together, we have like more power, we have a bigger voice, and we're able to kind of like oversee and make sure things are going correctly. But then the downside is because we don't have eyes and ears over there, we have to make sure that we find like the right partners and the right guys who have the experience, the backing, and like the integrity to make sure to do the right things. And so that's our jobs as like your representatives here in Hawaii to the mainland operators. And so one of the deals that we're working on in the mainland is in Houston. It's 102 unit. We're under contract right now. We put down some like our own earnest money for this. We're gonna probably be funding some of it with our own cash. But then we're working with these experienced operators in that market who live and work and breathe in the market, who have hundreds of millions of dollars invested and relationships that are already established in that market. So we don't have to reinvent the wheel or reestablish the relationships. We have guys who are actively doing it, who have a proven track record of success. And then now we're piggybacking alongside them to either take a small piece of the pie and then bringing our team and then our oversight to like kind of to the deal. So it's a 102 unit in Houston that we're partnering on with Eric Shadron and his team.
Awesome. Congratulations.
Thank you.
Yay. Well, thank you guys so much for today. We're about to run the clock. Oh, do we have another question? But thank you guys. If you guys want to connect with us, you can scan the QR codes. If not, if you're on your phone, we will send you an email with the recording and all the links to connect with us and Daniel. But Daniel, thank you so much for today.
Yes, Daniel.
Wealth
Thank
of knowledge. And you're always awesome to collaborate with. So
Cheers,
thank
you
you
guys.
so much. Yeah, and thank you for everybody that showed up and joined us today. We can't wait to connect with you all soon. Again, everybody's journeys are super individual. We want to be able to help you guys and use us as a resource and a tool for your guys' family's generational wealth, your journey of financial freedom. Use us. We're here to serve you guys and serve our families and move the Lahui forward. So thank you guys for today.
Thank you,
Yes,
guys.
and then
Thank
guys,
you.
if you guys just maybe started tuning into the multifamily space, we have a free ebook that give you a little bit more generalized information too. But there's links in the chat if you guys don't see it, but we'll send you guys an email and a recording so that everybody can re-listen to all of the knowledge that Daniel dropped today.
Yeah.
Mic drop.
Woohoo. But thank you guys. Okay, I'm gonna stop the share. Yeah.
Thank you.
Can we take a picture real quick with
Oh
whoever's left?
yeah, a picture. Let's take a screenshot. Ready? 1, 2.